Drew Pettit is with us, Director, U.S. Equity Strategy and ETF Analysis and Strategy Research at Citi. He's with us. Drew, great to have you back on the program. Thanks very much for your time. So I don't know if you should even touch upon the Fed. Is there anything new at all? Did we learn anything new?
I think you guys pretty much nailed it in the open of the show. No, it did feel like a non-event. The one thing I would say is that's really good news that it was a non-event, because I think leading into this, the U.S. market was actually more susceptible to a move higher in rates than it was maybe, say, a month or two ago. So honestly, non-event in rates after you had a little bit of that volatility in the middle of the day. But we kind of saw once it settled back down, equity markets came back off the lows of the day.
Okay, so what's keeping you busy in terms of tracking markets? Is it? By the way, let me ask about this entire AI thing after DeepSeek. I mean, what's the view? Latest, where are we at in terms of evolution of that view? Initially, it was a shock. Then it was like, okay, it's going to democratize the use of AI, lower costs for everything. We've had numbers from Meta, Microsoft, Tesla. I've not seen what they've said during conference calls, etc. But what's the view?
So honestly, our view hasn't changed. I think if you're going to position in a disruptive and new technology, you want to have exposure across the value chain. The thing is, when we think about the US market and stocks, we've been talking about NVIDIA and semiconductors for over 2 years now. But what we were seeing is opportunities in the creators, let's call it the application layer, like software, for example, and then some of the end users. That can be industrial companies and other types of companies that are going to take AI products and integrate it into their own products. That could be a car, that could be a better robot in manufacturing, that could be in navigation, for example, and make their products better. So what ended up happening on Monday is that AI trade punished the enablers. Anyone building data centers themselves, or semiconductors. It didn't really hurt the software creators making applications, because as you said, lowers your cost base, makes development easier and faster, and it actually helped some of the end users who were up on the day. So it was an AI sell-off, but it was a very concentrated sell-off.
Sure, yeah, and it's always, someone's loss is someone's gain, as they say. So even if you move to lower chip prices, the rest of the AI chain can probably benefit. And I completely concur. I've been hearing that view as well from a couple of experts. So understand that, Drew. But tell us, where are you putting the money? Beyond U.S. equities, are you looking at any other market? How are you looking at the rest of this quarter, say, in terms of just your deployment strategy?
Yeah, so funny. I'll give you something within the U.S. that I think is really interesting. Healthcare. So it's funny here politically, people have been worried about the healthcare names, but honestly, they're not priced for any good news. I think some of the pharmaceuticals in the United States basically just have to sell their current portfolios at expected rates to really make these stocks work. So I think healthcare and pharmaceuticals in the United States are an interesting trade to think of throughout this quarter. And then thinking globally, to answer your question, I think barbelling the United States with Europe, that's been our call. I think that's where you get value. Europe provides you value. Its revisions have really stopped moving lower. I think that is the opportunity, if we get a bit of a cyclical rebound there at really low valuations, to get a tactical bump if the U.S. hits some volatility like we expect near term.
But that's really interesting, Drew. So to play that tactical balance, you're looking at Europe and not, the original favorites, emerging markets like India or China, which are both not doing well. I mean, we take that. But Europe over some of these other themes?
Yeah, honestly, it really comes down to revisions have not been worse. Positioning also very, very, very net negative. So if you're looking for a value trade, that's where you have the most leverage. I really think our colleagues in Europe have really spun this very interestingly, because right now, like if you're looking for growth in the world, the growth engine has been US mega cap. It's been in the US indices. So in a sense, emerging markets gets you more cyclical structural growth. The United States, it really gets you this tech and thematic growth. So the barbell with the most leverage, honestly, we think is Europe right now.
All right. Hi, Drew, and good to see you, Ben. And you've maintained that stance, right? Neutral on emerging markets while you were relatively more positive on US as well as Europe. Where does India fit into this piece? Because from the time you had that neutral stance on emerging market, and India included, we have pulled back a few percentage points. What will make you turn your attention to India?
Honestly, I think a lot has to do with how really Trump and U.S. policy plays out from a global trade perspective. Honestly, when we think about markets globally in the U.S., right now it's kind of currency volatility that gets us nervous. And it's not so much backward looking, it's what can happen, forward looking with tariffs. Because honestly, we don't think markets globally have really priced in tariff risk. India could be a big beneficiary of that, especially if China, for example, I would say gets targeted more aggressively in tariffs, which seems to be the rhetoric. But honestly, right now, I think a little bit of a wait and see, more of a neutral stance in emerging markets makes sense until we really work through some of the potential headline risk coming out of the U.S. government.
Absolutely, Drew. And we just want to end with that, exactly that, whether you've been able to do the math around this and put any numbers to the tariff headlines that we have right now. So 25% Canada, Mexico, then I think he's at 10%, China to start with. What does all of that do in terms of just the implications and the impact on U.S. equities? What's your base case model on tariffs and the market impact?
So a little bit of back of the envelope math, because the problem here, when we think about the U.S., it's really a stock by stock problem. A lot of people have gone down the path of, some companies buy a lot from international sources. Maybe they're targeted, but if they're buying from an international source, manufacturing and selling in an international country, it actually doesn't get tariffed. So it's a little bit messy. Services don't get tariffed, goods do. So that's another thing we have to factor in. But high level, we think for every 10% increase in import price inflation, you should get 200 to 300 basis points of gross margin impact in the US market. We're going to have to narrow this down on a stock by stock basis. But where I think investors and where we want to look near term for impacts is in DXY, the US dollar index. So as the dollar index strengthens, we actually think that's a net negative for stock markets near term. And on top of that, let's go a step further, keep an eye on implied volatility on the dollar.
Right.
Because I think if that rises, which has come down in the past week or so, but we saw a little bit of noise around some of Trump's speeches, dollar volatility rising on top of a stronger US dollar is all equity negative. So I think we really have to kind of work through the headlines and see both of those come down to really be off to the races in equity markets again.
All right, Drew, thank you very much. Good conversation as always. Thank you for sort of taking us through all of that. Look forward to our next one.